Well, that's a market perspective, but let's get talking to Gagan Banga, the Vice Chairman and Managing Director of Indiabulls Housing, who joins in now. Gagan, thanks very much for joining in today. Well, there's been a lot of, good things which have been spoken about Indiabulls Housing Finance just in the past couple of days. Like, for example, Macquarie on their investor roadshow, Indiabulls was one of the most talked about stocks, or investors were one of the most interested in Indiabulls Housing Finance, and Nomura upgraded your stock just yesterday as well. But can you just start by telling us how things are looking like on the ground? Because where is cost of funds right now for Indiabulls Housing Finance, and where do you expect it to go in FY16?
So, as far as cost of funds is concerned, the company got a credit rating upgrade last year in July of 2014. Subsequently, our cost of funds has substantially reduced, especially for our bond borrowing program. And the bond borrowing program has also increased as a percentage contributor to our overall liabilities. So overall, on our cost of funds, we've already seen on a year-on-year basis something like a 50 basis points reduction, and on incremental borrowing we are seeing almost like a 70 basis points reduction. So there is a lot of tailwind which our business is gaining because of the rating upgrade and overall relatively benign interest rate environment. And as interest rates head down further through the course of the next 15 to 18 months, as is generally expected, I would believe that Indiabulls Housing should be a disproportionate beneficiary of the entire downward movement of interest rates. And it is a very interesting position that we are in today. Thanks to this rating upgrade, I believe that there would be savings which would be unique to us, and those savings would continue to magnify as bonds become an increasingly larger portion of our borrowing mix. So over the course of the next 2 years, I think we are in kind of a sweet spot as far as the overall borrowing costs are concerned.
All right, Gagan, point well taken there. We just hold on to that thought. We're getting some further news in. We're having news that, in fact, Yes Bank has cut its base rates by good 25 basis points approximately. So, Ekta, that's more or less on expected lines, I'm guessing, because we have been seeing that quite a few banks have been cutting base rates. So I think it's really follow what's been happening.
Yes, well, it's come down to 10.5%, so it's higher than most of the other private banks or banks at this point. But we did hear about HDFC Bank just cutting their base rates by 15 basis points, an additional one just yesterday. So it's a total transmission of 30 basis points out of the 75 basis points which the RBI has cut. So the Yes Bank has now cut their base rates by 25 basis points, and I would need to actually see whether they've cut their base rates before, but nonetheless, 25 basis points, 10.5% is the lending rate where they're at. Gagan, in fact, come in on this. What is the competition dynamics looking like at this point in time, considering, within the housing space at this point, what is the sort of competition that you get from PSU banks or maybe private banks within the housing retail space?
Yeah, so given our focus on essentially doing home loans which are below 25 lakhs, and within that also we operate in a relatively tight range, so we try and do loans between 20 and 25 lakhs. RBI has just increased the priority sector qualifying home loans to 28 lakhs, so that would increase our focus now to 20 to 28 lakhs. So that's really the sweet spot for Indiabulls Housing, and in that space we have usually we find competition more from private banks and some select few housing finance companies. Public sector banks are there, but their focus is generally more on catering to their existing clients. Their distribution is also still more branch based, whereas a distribution model for an organization like Indiabulls or any other private bank would be more construction site based. So we acquire most of our clients on the construction site, and today, given where our size or market share is, I believe for us to continue to grow both market share as well as to continue to grow our disbursements in the range of 20%, to continue to grow our book in the range of 25%, while retaining our focus on this segment of 20 to 28 lakh of rupees of loans is quite possible. Clearly, public sector banks are constrained by the fact that their distribution is restricted to branches. We would therefore be disproportionate beneficiaries of how the entire mortgage market grows. Mortgage market for the last few years has been growing in the range of 16 to 18%. Private housing finance companies have been gaining market share and now control almost 39% of the overall mortgage market and have been growing at about 22%. Indiabulls has been growing pretty much in that range, and I think this number of 22% is what we would continue to grow by.
All right, Gagan, just going back to the cost of funds, what exactly is that number? You were giving us various details that it's come down by 70 to 80 basis points. Could you give us that number?
So 9.6% is where the stock is, and we would incrementally be borrowing at just under 9.5%, around 9.4, 9.45% in that range.
All right, Gagan, also we're talking about growing your loan book by nearly around 20, 22, 25% approximately. Where exactly do you expect the traction to come in from? The tier 1, tier 2, what's your thoughts on that?
I'm sorry, I didn't.
You're expecting your loan growth, I mean loan book to grow by nearly around 22, 25% if I was right. Where exactly do you see the growth coming from? From the tier 1 cities, from tier 2 cities? Where exactly do you see that uptake that will come in?
Yeah, so our distribution is largely focused on in suburban locations, the outskirts, the suburbs of large tier 1 cities and a bunch of tier 2 and tier 3 cities. Today, with our branch network of over 200 branches, we cover close to about 90% by value of real estate transactions that happen in the country in terms of our city presence. And we would continue to focus on opening more